Unless you plan on dying early, you really should have a retirement plan. But if you are planning on dying early, then you probably should still have a retirement plan. So, in conclusion, you should have a retirement plan. My name is John Ross with Finance on a Budget. In this video, we'll be talking about how to make the most out of your money during retirement so that your golden years will be as comfortable as possible. This includes different ways to get around hefty tax consequences. There are also different types of retirement accounts that you can choose from, and each one will be taxed differently. How and when you take the withdrawals will affect how much these taxes are going to set you back. You should try to be strategic and prioritize those withdrawals for your recommended minimum distributions. While you are free to start retiring at 59 and a half, there are those mandatory withdrawals that will start at age 70 and a half, meaning that you will have to start taking that money out even if you don't want to.
I don't want it.
You don't want it.
Also, it's best if you focus on turning your retirement assets into retirement income that you can rely on. Remember, an asset is something that will continue to make you money just for owning it. One example would be dividend stocks, where they will pay you a certain percentage just for owning that stock. This is a great example because the more stocks you buy when you're young, the more that they will pay you throughout the years. If you simply reinvest the money, buying more stocks of that company over the years, during your retirement, you can actually live off of those dividends that they pay you. Additionally, try to wait as long as you possibly can before starting to claim Social Security. You can maximize its lifetime value for a higher standard of living. The longer you leave the money in there, roughly waiting until the age of 70 will pay you a minimum of 32% more. Since dividends don't pay quite that much, you may be best to wait. However, you should speak with a financial advisor before listening to some random guy on YouTube. Speaking of YouTube, please give this video a like, subscribe, and ring that notification bell. And, of course, don't forget to leave comments. IRA, Roth IRA, and 401ks in retirement. I have a full video comparing and contrasting these different types of savings accounts, and I'll have a link in the description below. But on the surface, an IRA is pre-tax money. This means 100% of what you put into it can be used to purchase different kinds of things like stocks, and technically gold, bonds, and cryptocurrency as well. In fact, you can even invest your IRA directly in another business as long as you don't have a direct affiliation with that business. This could be private business, but it could also mean startups, real estate, and small businesses. This means that you can use your IRA to invest in a real estate development company as long as you are not directly affiliated with that company. This starts getting complicated, and there are definitely rules on how this works. However, I'm just letting you know that investing in IRA means a lot more than just buying stocks. But the key here is pre-tax. You will not have to pay any taxes until you have retired, which will allow you to actually pay less taxes since you have a lower income than when you were still working. So this makes a lot of sense. A Roth IRA differs in that you will pay the taxes first, then invest the rest after. The benefit here is that you can pay your taxes when you're young and you can't afford it. When you're ready to take the money out, you don't even need to be retired yet. The reason is that since you already paid the taxes once, you will not have to pay the taxes again on the principal invested money. Only the profits would be taxed, so this does have its own benefits. But ideally, you could invest in both so that the funds are more diversified when you reach retirement. However, this does not mean that you would be able to put in twice as much. The limit is still the same, about $6,000 a year between the two accounts. Your company's 401k is a little bit different. The limit here is $19,500 a year, or $26,000 if you are over the age of 50. You are actually allowed to contribute to them along with your IRA for the previously mentioned $6,000 a year. Plus, if the company you work for has dollar matching, then you could be getting even more pre-tax money working for you throughout your lifetime. Don't forget a health savings account, HSA. If you think that the government has your health covered, you must be living in Canada, because here in the United States, we can't rely on the system entirely. Statistics show that a 65-year-old couple can expect to shell out a whopping $285,000 in out-of-pocket health care if they retire in 2019 and continue to spend for medical expenses throughout the retirement. Medicare doesn't cover everything, so you will need to have your own funds to dip into when the worst happens. This is why investing in a health savings account, HSA, when you're young can go a long way towards your retirement. I will have a separate video covering these forms of long-term savings, but basically, you can then put your money into it as tax deferred. While the money is just sitting there, you can either make money like a savings account at a 1% annual return, or like a self-directed IRA, buying dividends or ETF stocks at 3 to 6% annual return, or let a brokerage manage the investment of the money, most likely index funds, again 3 to 6% returns. But the main point of the HSA is that when you have a medical emergency, the tax-deductible money that you put into it, combined with the tax-free profits from investing, can be used to cover your medical expenses throughout your life. Remember, other long-term investing would hit you with high fees for early withdrawal or capital gains tax. As long as this HSA money is used for medical expenses, you will not incur any additional fees. But again, I'll have another video covering how this works. Your big takeaway from this video should be to diversify your funds across IRAs, Roth IRAs, 401ks, and HSAs in order to maximize your money throughout your lifetime so that every situation is covered. A little today can go a long way towards tomorrow. If you like this video, please be sure to give it a like, subscribe, and ring that notification bell. Thanks for watching.